Good afternoon, everyone. Welcome to week 3. I'm going to get us started in the discussion with a discussion on cost basis. The most frequently applicable original basis is a cost basis. Cost basis includes cash, fair market value of other property, debt, and transactional costs incurred during the acquisition. So here you have a formula for cost basis. It includes cash plus the fair market value of any property that's given in the exchange, plus shipping, installation, and insurance while the item is being transported, plus any Section 263 UNICAP items, plus construction loan interest. So if you're constructing an asset such as a building, while the building is under construction, while it is being made ready for its intended use, the interest on the loan, it becomes part of the building. So it's not written off as an expense, it's capitalized, and it becomes part of the cost of the building. Uniform capitalization rules, these are mandated for certain kinds of inventory and certain other property. And as I said, construction period interest and taxes, these have to be capitalized for certain long, useful life property. With homogeneous property, such as identical blocks of common stock, then specific identification of the property may not be possible. And so in this case, the tax law requires a FIFO approach. Owners of mutual funds, they may use an average cost method in addition to FIFO and specific identification. According to the IRS, the basis of property you buy is usually its cost. The cost is the amount that you pay in cash, any debt obligations that you take on, any other property that you might exchange, or services that you might exchange. Your cost also includes amount that you pay for the following items: sales tax, freight, installation and testing, your excise taxes, legal and accounting fees if they must be capitalized, revenue stamps, recording fees, and real estate taxes if you're assuming that liability for the seller. Additionally, the basis of real estate and business assets may include some other items. If you buy property on a time payment plan that charges little or no interest, then the basis of your property is your stated purchase price minus any amount considered to be unstated interest. You generally would have unstated interest if your interest rate is less than the applicable federal rate. Before figuring gain or loss on the sale, exchange, or other disposition of property, or figuring allowable depreciation, depletion, or amortization, you have to usually make certain adjustments to the basis, which are increases and decreases, other than the cost of the property. And the result that you get is called the adjusted basis. Increases to the basis of any property by all items properly added to a capital account. So for example, things like capital improvements, putting an addition on your home, replacing the entire roof, paving a driveway, installing central air conditioning, or rewiring your home. These were all things that would increase your basis. So improvements, they add to your basis in property the cost of the improvements if they have a useful life of more than 1 year, and they increase the value of the property, they lengthen its life, or they adapt it to a different use. So for example, improvements including putting a recreation room in your unfinished basement, adding another bathroom or bedroom, or putting up a fence, putting in new plumbing or wiring, installing a new roof, or paving your driveway. These are all things that would add to the basement. Also, assessments for local improvements. You would add to the basis of the property Assessments for local improvements such as streets or sidewalks, if they increase the value of the property that's being assessed, do not deduct them as taxes. However, you can deduct as taxes assessments for maintenance or repairs or for meeting interest charges that are related to the improvement. So for example, if your city changes the street in front of you or in front of your store into an enclosed pedestrian mall and assesses you and other affected property owners for the cost of the conversion, then you would add the assessment to your property's basis. So in this example, the assessment would be a depreciable asset. There are also decreases to basis. So you would decrease the basis of any property by all items that represent a return of capital for the period during which you held the property. So this would include things like exclusion from income of subsidies for energy conservation measures, casualty or theft loss deductions and insurance reimbursements, the postponed gain from the sale of a home, things like alternative fuel vehicle refueling property credit, residential energy credit, depreciation in Section 179 deduction, easements, and certain canceled debt excluded from income. So let's look at a quick example. So consider that you owned a duplex that was used as rental property. It cost you $40,000, of which $35,000 was allocated to the building and $5,000 to the land. You added an improvement to the duplex that cost $10,000. In February last year, the duplex was damaged by a fire. Up to that time, you had been allowed depreciation of $23,000. You sold some salvage materials for $1,300 and collected $19,700 from your insurance company. You deducted a casualty loss of $1,000 on your income tax return for last year. You spent $19,000 of the insurance proceeds for restoration of the duplex, which was completed this year. You must use the duplex adjusted basis for the restoration to determine depreciation for the rest of the property's recovery period. Figure the adjusted basis of the duplex. So you have the original cost of the duplex, $35,000, the addition to the duplex for $10,000. That brings the total cost of the duplex to $45,000. You have to subtract your depreciation, which was $23,000, and so then you have an adjusted basis before the casualty of $22,000. And then with your adjusted basis before the casualty of $22,000, you're going to subtract the insurance proceeds of $19,700, the deducted casualty loss of $1,000, and the salvage proceeds of $1,300. You're going to total those up, and they total $22,000. You'll subtract to get your adjusted basis after the casualty. This is $0. And then you'll add the cost of the restoring the duplex, and this gives you an adjusted basis after restoration of $19,000. Your basis in the land remains the original $5,000 because remember, land is not really depreciable in America, and we don't improve it. We improve buildings, not so much land. Okay, so thinking about all of these concepts to get us started, I'm going to post a question below this for you to answer, to consider and answer. And so I will see you in the discussion. Have a great week, everyone.